Welcome back, accounting students. This is Mrs. Bloomquist, and remember, we are currently in Chapter 15, and Chapter 15 deals with the adjusting entries in a trial balance for a merchandising business. So we are getting close to the end of the accounting cycle for a merchandising business. As we look at Lesson 2, you can see that we're going to be adjusting merchandise inventory and interest receivable. In our last lesson, we learned how to calculate and record adjustments for supplies and for prepaid insurance. And this lesson, we're going to be looking at merchandise and then interest receivable. And we're going to be looking at entries that are unique to that merchandise business, different than when we were looking at a service-based business in the first half of the book. So we just want to keep in mind that one of the concepts we've learned is that we want to make sure we're recording revenue when the sale is made, whether it's for cash or on account. So now we want to pick up the concept about accrued revenue and thinking about interest that we know we're going to be receiving. So we want to make sure that we have that concept well in hand as well. So as we look at the two objectives, we're going to be adjusting merchandise inventory, and then we're actually going to be also adjusting interest receivable. First, we're going to start out with some definitions, and the amount of material that we have on hand at the beginning of a fiscal period would be our beginning inventory, and we all recognize that during a specified time period we have merchandise that's purchased, merchandise that's sold. So we have merchandise that's purchased by the company and brought in and sold then to our customers. And so at the end of our accounting period, we're going to conduct some kind of physical inventory and figure out what we actually have on hand. And then once we have that actual count, that is what we use to determine our ending inventory. All right, so to record an adjusting entry for our merchandise inventory, we want to be thinking about the accounts that are going to be impacted and whether or not we're going to be doing a debit or a credit. So we can think about our merchandise inventory, and we're thinking about our December 31st balance, and we're making a credit or an adjustment that's going to be reducing our assets. So because merchandise is an asset, and then we're going to go ahead and adjust our income summary. So you can see on our trial balance that we're going to be recording our merchandise inventory here, right, our unadjusted trial balance for December 31st. And then in our general journal, we now have on the 31st the income summary that is our debit and our merchandise inventory that is our credit. So we're reducing the amount of merchandise that we have in inventory based on our actual physical count. Okay, so the next thing we want to be thinking about is journalizing and adjusting entry for interest receivable. And we want to make sure that we understand that interest that we know we've earned but we have not yet received is accrued interest income. So that we make sure that we understand we've accrued for it on our books and it's going to be coming in later. So make sure that, you just want to be aware that that's part of GAAP, is generalized accounting procedures, that you record for that accurately. So in our interest receivable, a debit is an increase and a credit is a decrease, so that's an asset. And our interest income, debit decreases and credit increases. Okay, so we're going to be, for our interest expense on our trial balance, you can see that our interest receivable is 93 on the debit and the interest income is 93 on the credit. Okay, and that's just going to go ahead and reconcile and post those adjusting entries for interest we know we're getting in the future. Okay. Quick! Only two little things in this lesson. Don't you love when that happens? I love when that happens. Although I feel like, man, we're flipping pages over in our book so quickly, right? How is the amount of merchandise inventory on hand at the end of the fiscal year determined, what do you got to do? You have to do a physical inventory. And I don't know if any of you ever had jobs where you had to go and count for inventory at the end of the year, but it really stinks. And so if you ever have that kind of a job, I'm sorry for you because it's not very fun. Question number 2 would be, what adjusting entry is recorded when the ending merchandise inventory is greater than the beginning value? We would be debiting merchandise inventory and we would be crediting income summary. How often is revenue earned on an outstanding note receivable? Ooh, good question. How often is it that we actually get to go ahead and earn that income? Daily, my friends, daily. What types of accounts are increased by recording an adjusting entry for accrued revenue? The adjusting entry for accrued revenue increases a revenue account and it increases a receivable account. So you just want to make sure that they're both increasing and one's a debit and one's a credit. All right. The other thing, that you might want to be thinking about in terms of your business records is what the implication might be of putting all of our accounts receivable and all of our notes receivable into one account, since, the reality is they both reflect receipt of cash and they're both assets. But you want to be thinking about how you would want to keep the reporting of those separate so that when you generate financial reports, you are able to use the financial reports you created for management decisions more effectively. So we wouldn't want to lump those together because they're not really a good and accurate reflection of what's going on with our business. So with that said, we are now done with lesson 2 for chapter 15. Go ahead and complete the forms online, the work together and on your own, and then move on to lesson 3. Good luck, everyone.